The Fed made a big change in their statement this past week that is going to have a direct impact not only on mortgage rates, but also on the housing market. This past week, the Fed raised the Fed funds rate 0.25%, signaling that the latest rate hike could be the last. Fed Chair Jerome Powell also said that the U.S. banking system is sound and resilient, but then goes on to say that inflation remains too high, saying that they're strongly committed to bringing inflation back down to their 2% target. And while inflation has come down off the peaks that we saw last June, as you can see from this chart here, there's still a big gap where we currently are with inflation versus where we need to go in order to hit the Fed's 2% target. The Fed also said we will continue to closely monitor conditions in the banking system and be prepared to use all of our tools as needed to keep it safe and sound. So what exactly changed in the Fed's statement that makes everyone out there think that there's a chance that this could be the last rate hike and that the Fed's decision could keep interest rates from actually moving higher? So before we dive into that change in the Fed's statement, I'd like to take a minute and ask a favor. If you find any value in my videos at all, do me a favor and hit that thumbs up. Also, feel free to subscribe to the channel to stay updated on everything real estate related. So while the Fed had a couple of different changes in their statement, there was one statement that really had a bigger impact than any of the other statements in the actual Fed release. The committee will closely monitor incoming information and assess the implications for monetary policy. The committee anticipates that some additional policy firming may be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. As you can see from this statement here, there's a red line going through ongoing increases in the target range, which essentially read to most people out there that there's a high probability that the Fed is considering backing off further rate increases in the future and instead likely doing a pause in keeping interest rates where they are. And as soon as that statement was made, interest rates actually improved. And you might be watching this video going, okay, the Fed hiked the Fed funds rate by 0.25%. That directly affects interest rates, right? How do interest rates improve? And the answer is no. The Fed funds rate does not directly impact interest rates. In fact, here's a statement from Matthew Graham over at MBS Live that explains exactly why the Fed hiked and interest rates improved. Now, I'm going to read this statement because he said it better than I can say it ad lib, so I'm going to read it directly so that you can fully understand how the Fed funds rate and interest rates aren't directly correlated. First off, the Fed funds rate is not a mortgage rate, nor does it directly affect mortgage rates by the time the Fed actually hikes or cuts. More importantly, Fed Chair Powell spoke about upcoming tightening of lending conditions due to the recent banking drama. That may seem like a simple enough comment, but it carries a lot of weight in terms of shaping economic momentum. Lending and credit are critical to growth and inflation. If lending subsides, fewer loan programs, or more restrictive requirements to qualify, it puts additional downward pressure on inflation, and inflation is the key reason rates have remained high. We've talked about that over the last couple of months. As inflation comes down, interest rates should follow. He goes on to say, long story short, in spite of the Fed rate hike and the relatively unchanged outlook for 2024, the market saw some indication of policy pivot in Powell's comments, some shifting of the big picture cycle of economic growth and inflation. Either that or Powell's warning on banks caused investors to fear additional banking issue in the days, weeks ahead. And with that, the result was an impressive improvement for the average lender, with 30-year fixed rates dropping nearly 1/4 point in many cases. And with that, we actually saw interest rates drop to under 6.5%, as you can see from this chart here. And with that drop in rates, we actually saw home buyer demand pick up again for the third week in a row. But clearly, we're not out of the woods just yet, as jobless claims unexpectedly declined for a second week in a row. So the job market remains resilient, even in the face of layoffs from companies like Amazon, Accenture, Meta, and even Indeed is laying off people. And with that, JPMorgan says that the U.S. is likely headed for a recession and that we're already past the point of no return. And on top of that, you have the Mortgage Bankers Association chief economist Mike Fratantoni saying that the increase was a dovish hike, saying that the commentary and the economic projections suggests that we may be at or near the peak of Fed fund hikes. And they go on to say that the FOMC statement actually supports the Mortgage Bankers Association's view of where interest rates are going to be at the end of the year, saying that their March forecast actually calls for the 30-year fixed mortgage to be sitting somewhere near 5.3% in the fourth quarter, which is down from nearly 6.4% where we sit today. So if this really is the end of Fed rate hikes and organizations out there like the Mortgage Bankers Association see interest rates coming down near the fourth quarter, what does that actually mean for housing? Well, last week we actually saw home sales spike nearly 14.5% in February, and that primarily had to do with interest rates going lower in December and January, getting buyers off the fence and back into the housing market. And with those buyers getting off the fence, it created additional buyer demand coming back into a housing market where inventory hasn't really picked up. In fact, new listings for the year are sitting below 21 and 2022. So there's less homes coming to the market, which is added to that supply and demand imbalance. So when we had more demand come to the market than we actually had supply out there, that created a frenzy in a lot of markets out there, multiple offers again in a lot of markets out there. And that's exactly why we saw that jump in existing home sales. Now, this was the first monthly gain in nearly 12 months and the single largest gain since July of 2020. But here's the key takeaway. Sales were down nearly 23% from February of last year, which primarily has to do with housing affordability, just less buyers out there being able to afford homes. Now, there will be people out there that point to the fact that median prices did drop for the first time in over a decade. And this is according to the National Association of Realtors. But here's the thing. The median home price from the National Association of Realtors doesn't really hold a lot of weight in the way that it's calculated. If you really want to see what home prices are doing year over year, I think it's important to look at something like the Case-Shiller Home Price Index, which actually measures home price inflation by looking at repeated sales of single-family houses versus taking the median price. The reason the median price is lower is because there's less homes selling at a lower price point because of that affordability issue. So yes, home prices are going down, but don't give the median home price a ton of weight because it's often measured too high as home prices are going up, and it's often measured too low as home prices are starting to pull back. But with that said, unsold inventory is currently sitting at 2.6 months of inventory, somewhere around 414,000 homes in the entire United States. And because of housing affordability, the lack of inventory out there, we're actually seeing first-time home buyers getting squeezed even further, only making up 27% of buyers compared to 31% in January. Also, something important to note, 28% of transactions out there happening in February were cash transactions. And for all of those people out there talking about foreclosures coming, foreclosures making up a big percentage of the market, distressed sales only represented 2% of sales in February, which is nearly identical to last month as well as identical to a year ago. So what does that actually mean for you if you're a buyer out there? Well, I do believe that rates are likely going to continue to trade in this range that we've seen over the last couple of weeks, somewhere between 6 and probably 6.5%, unless we get additional issues out there in the banking system. But even then, we know that the federal government is going to jump in. They're going to bail them out. So it's not likely to have a much bigger issue, but that could create volatility in the market, which would allow interest rates to move lower. At the same time, I believe that inflation will continue to moderate. As we start to see the lag in rent and shelter data catch up, that's going to allow inflation to come down quicker. And in turn, interest rates should follow. But here's the conundrum that I'm having. At the moment, we don't have a lot of supply out there. Interest rates are somewhere in the mid 6% range, and we have home buyer demand out there, right? We don't have a lot of inventory. We have buyers buying homes. In the market that I'm in at the moment, our inventory is at the lowest level we've seen since April of last year. In fact, we're down about 18% in inventory since the start of the year. So if interest rates move lower, that's going to create additional demand in the market, putting a further strain on the homes that are currently listed, which in my eyes creates additional problems. So you need more sellers to put their homes on the market to help balance out this equation. So my question to you as a viewer watching this video, where do rates need to go to unlock this inventory, if you will? Where do we need to see interest rates go that a seller that is contemplating selling their home says, yeah, that's an interest rate that I'll trade my super low rate for. It may not be my super low 3%, but it's close enough. I'm willing to list my house and sell it if I can get that rate. So what rate is that? I'd love to know in the comments below where you think rates need to go to unlock that inventory. Now, if you're one of those people out there going, Jeb, you're absolutely crazy. There's no chance that interest rates go back down. They're going to continue to go up. Well, if that's the case, and interest rates do go up, which I don't believe is going to happen, yes, that could put a further strain on housing prices, bringing them down. But I don't believe they're going to crash though, because that's going to further lock sellers in place where they're absolutely not going to go anywhere. And in order to have a crash, you need excess inventory.